What if you could shave thousands off college costs just by using the right strategy without earning a single extra dollar? Most people open a 529 plan and stop there, but that's where they leave serious money on the table. From timing your contributions to maximizing tax advantages and avoiding common withdrawal mistakes, small decisions can make a huge difference. In this video, I'm breaking down 5 smart moves to help your 529 plan grow faster, work harder, and actually cover more of those rising education expenses. Start contributing to a 529 plan as early as possible to maximize tax-free compounding growth. Time is the single most powerful factor in a 529 plan because all investment earnings grow tax-free when used for qualified education expenses. For example, if you invest $200 per month starting when your child is born and earn an average 6% annual return, you could end up with around $38,000 by age 18. If you wait until they are 10 years old to start, that same $200 per month may only grow to about $12,000. That is a massive difference created purely by time. Contributions are made with after-tax dollars, but many states offer a state income tax deduction or credit, which can immediately reduce your tax bill. For instance, if your state offers a 5% deduction and you contribute $5,000, you might save $250 in taxes that year. To make this automatic, set up recurring monthly contributions from your checking account so you do not rely on willpower. Choose an age-based portfolio that automatically shifts from stocks to bonds as the child approaches college, reducing risk over time. Starting early also allows you to take more investment risk initially, which can potentially increase long-term returns. The key takeaway is that even small amounts invested consistently from an early age can significantly reduce how much you need to borrow later, saving you thousands in student loan interest. Take advantage of state tax benefits by contributing enough each year to capture the maximum deduction or credit. While federal tax benefits for 529 plans are focused on tax-free growth, many states provide upfront incentives that can make your contributions even more valuable. For example, if your state allows a $10,000 deduction for married couples and your state tax rate is 4%, contributing the full amount could save you $400 in state taxes. That is essentially an immediate, risk-free return on your contribution. However, these benefits often have annual limits, so spreading contributions across multiple years can maximize your total tax savings. Some states also allow carry-forwards if you contribute more than the annual limit. Be aware that not all states offer benefits, and some require you to use your own state's 529 plan to qualify. Others allow you to contribute to any plan and still receive the tax break. Check your state's specific rules carefully. If you are a grandparent or relative, you may also be eligible for these benefits depending on residency and ownership of the account. The strategy here is to treat your 529 contribution like a planned annual tax move, similar to contributing to an IRA, so you consistently capture every available tax advantage instead of leaving money on the table. Use strategic gifting rules, including the 5-year gift tax election, to supercharge contributions without triggering gift taxes. The IRS allows you to contribute up to the annual gift tax exclusion amount per beneficiary, which is $18,000 per year for individuals, or $36,000 for married couples, as of recent limits, without filing a gift tax return. However, 529 plans have a unique feature that lets you front-load up to 5 years' worth of gifts at once. That means a married couple could contribute up to $180,000 in a single year per beneficiary and elect to spread it over 5 years for gift tax purposes. This strategy can significantly boost the account balance early, giving more time for tax-free growth. For example, investing $100,000 upfront instead of spreading it over 5 years could generate thousands more in earnings over time. You will need to file IRS Form 709 to make the election, even though no tax is owed. This approach is especially powerful for grandparents who want to reduce their taxable estate while helping fund education. Keep in mind that once you make the 5-year election, you generally cannot make additional exclusion gifts to that beneficiary during that period without affecting your lifetime exemption. Used properly, This strategy accelerates savings and leverages both tax-free growth and estate planning benefits. Choose low-cost, diversified investment options within the 529 plan to minimize fees and improve long-term returns. Fees may seem small, but they compound over time and can significantly reduce your final balance. For instance, if you invest $50,000 and earn 6% annually over 15 years, a plan with a 0.2% expense ratio could leave you with about $119,000, while a plan charging 1% could reduce that to around $107,000. That is a $12,000 difference just from fees. Most 529 plans offer age-based portfolios and static options like index funds. Index-based portfolios are typically lower cost and broadly diversified, which helps manage risk while keeping expenses down. Review the plan's program manager fees, fund expense ratios, and any account maintenance charges. Also, consider whether your state's plan is competitive or if an out-of-state plan offers better investment choices, especially if your state does not provide tax benefits. Revisit your investment allocation periodically, especially as the beneficiary gets closer to college, to ensure you are not overexposed to market volatility. Keeping costs low and diversification high is one of the most reliable ways to improve your overall outcome without taking on additional risk. Use 529 funds strategically for qualified expenses and coordinate withdrawals with tax credits to avoid unnecessary taxes or penalties. Qualified expenses include tuition, fees, books, supplies, and in many cases room and board, if the student is enrolled at least half-time. Up to $10,000 per year can also be used for K-12 tuition. And there are limited uses for student loan repayment. The key is that withdrawals must match qualified expenses in the same calendar year to remain tax-free. If you withdraw more than you spend on qualified expenses, the earnings portion of the excess becomes taxable and may incur a 10% penalty. Coordination with tax credits, like the American Opportunity Credit, is crucial. For example, you cannot use the same $4,000 of tuition to both justify a tax-free 529 withdrawal and claim the credit. A smart approach is to pay at least $4,000 of tuition out of pocket to claim the credit, then use 529 funds for the remaining expenses. Keep detailed records of all expenses and withdrawals in case of an IRS audit. Also, consider timing your withdrawals, such as taking distributions in the same year expenses are incurred, not in December for a bill due in January. Proper planning ensures you maximize tax benefits, avoid penalties, and stretch your education savings as far as possible.